Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to cover your questions that were submitted in our December 2025 listener questions episode. And like we were talking before we hit record, Justin, it's interesting to see each month there's a theme that sort of evolves from the questions that are submitted over, about a usually month or two time period that I'm pulling from to put this together. And so it seems like it's like there's a collective consciousness that's acting, and people are thinking about some of the same things each time. Yeah,
you said it, Matt. You said, sometimes a lot of the same questions, but then, sometimes it seems like we get kind of more obscure questions, but multiple people asking those, which is interesting. That seems to be the case today.
Yeah, absolutely. Well, do you want to go ahead and dive into this first one from Joseph Long that was submitted via YouTube?
Yeah, absolutely. And we seem to be getting a lot of questions about shut-in wells, Matt. When we were at the National NARO conference, that was what a lot of folks wanted to talk about. And so, Matt, the first question here is from Joseph, and he says, we've been trying to find shut-in wells in Texas and would love to see a podcast on how to generate that list using the Texas GIS software. Thanks so much for all the information you provided. And Matt, that is something that you can do. And the GIS system is pretty complicated. But Matt, we did a YouTube video on how to navigate that, which is something you can certainly look for if you search the Mineral Rights Podcast on YouTube. And according to the Texas RCC, they define an inactive well as once a well has reached 12 consecutive months of no reported activity, the well becomes subject to the state rule 14b2. And unless the commission approves a plugging extension, then that's kind of the guidelines that the Texas RCC sets for when a well should be shut in. I think, there's a lot of different states handle that differently, and how transparent it is can also vary by what state you're in.
Yeah, and I assume you mean when a well must be plugged, right? So if a well has been shut in, it's okay and no big deal. But once it's been there in that status for over a year, that's when they start tracking it. And there's this inactive well aging report that you can search, Joseph, and we'll link to this in the show notes. This is essentially the list of wells that are shut in that may be repaired and brought back on production. And then most of them are going to be plugged and or they are orphan wells. So that, and when I say orphan well, I mean a well that's inactive and the operator has basically abandoned it and has maybe gone out of business or whatever. And so they haven't plugged it properly. So there's 119,000 inactive wells in Texas as of November 15th, 2025. And that means, like Justin mentioned, an inactive well is one that's no production or no activity for over a year. And so there's a way you can search that. And, again, you can filter it. It's just an Excel spreadsheet that you can download, and you can filter it by operator, by well, by county, all sorts of attributes that you can use to search this list. So it depends on when you're looking to find shut-in wells. Joseph, if you're looking to find the stuff that's been out there for a long time, that would be that inactive well aging report. And we'll, again, link that in the show notes where you can find that. And if you were just looking for wells that are shut in less than 12 months, I think you could potentially search the information as far as the production data or looking at well information and seeing the status of those wells. That's something I'd have to dig into a little bit deeper. But I think really that in that case, if you're interested about a shut-in well, you're generally interested about wells that you receive royalties on or that you have an interest in. And in that case, you would just need to go through and follow that video that Justin mentioned. It was episode 226, where we show you how to use the Texas Railroad Commission website and use that video to find your wells. And then when you click on the well, you'll see information about it, including the lease number, the formation, and then it'll have on there the well status. It'll say if it's producing or if it's inactive or whatever. And so you can look at that, or if it's been plugged, too. That's the other, there's a bunch of different well statuses you can see on the GIS website, and then figure out what's going on with your wells. And so if a well does get shut in, you can see when it got shut in, how long it's not been producing. And then use that information to contact the operator, because ultimately that information is publicly available. And then, you want to use that to you can find information out sometimes by contacting the operator, finding out what their plans are for bringing the well back on production. It's not uncommon for a well to get it shut in, and it could be for, various reasons. It could be that there was, there's a pump jack on it, and there's a rod that goes that the bottom hole pump connects to the pump jack at the surface, and maybe that parted, and they have to go in and bring a workover rig and pull that and fish out the parted sucker rod and replace it. Or it could be that maybe they're completing other wells in the area and they're doing it preventively. So they're shutting in the well, let it build pressure so that it doesn't get damaged when they complete or hydraulically frack the other wells adjacent to it. And you can kind of figure that out just by looking at the website and seeing what activity is going on nearby. And if you don't have any questions, just contact the owner relations department of your operator, and they should be able to fill you in.
Yep, you said it, Matt, and that's a good thing to do. Typically, you're not the only one asking if they are working on the well or something's going on, and so there's not going to be a surprise that you're reaching out. Sometimes the hardest part is getting to the division order analyst, but once you do, they can typically answer those. All right, Matt, so our next one here is from Maria. Maria says, our mineral rights in California. It was supposed to be inherited. However, I was told I have to buy in. My ownership is only 12.5%. They are an S corp and use the pass-through on taxes to me. How should I claim it? Is there any deductions I can use? And some other questions about whether it falls into an LLC. She also mentions that she's being taxed on the money in various states. And so, Matt, this sounds like a pretty complicated tax situation. So to start with, this is not tax or financial advice. So be sure you work with a qualified CPA. But Matt, this can be a surprise, especially if it's recently inherited. We hear that a lot with step up in cost basis. How do they handle it in the first year of filing their taxes? Do you want to talk a little bit about some of the common pitfalls there?
Yeah, that's a great point. And it sounds like she has a very complicated ownership structure with an S corp going into through an LLC where she owns other real estate in many different states. So in that very complex situation, like Justin said, definitely talk to your CPA. But just in general, we'll talk about the different types of structures you can own minerals in. And the most common are an LLC. So that's a limited liability corporation. It's very easy to set up. You can do that even if you don't have a plan to run a business per se. You can use it as a structure to own or hold the mineral interests and royalty interests that you own. You can also put it in a trust. The benefits of an LLC or a trust is you can potentially avoid probate of the ownership of those interests. If it, when you pass away, if you have a strong operating agreement with the LLC, that would determine who, where the ownership interest would transfer to. That could potentially have to go through probate depending on the situation, but the actual minerals themselves would still be owned by the LLC. That wouldn't have to go through probate. Similarly, with the trust, you can set it up so that you fund the trust. In other words, that you deed the minerals over to the trust. And by doing that, you can potentially minimize the need from having to go through probate and having your heirs have to deal with the time and expense with all of that. Now, there's also the S corp route. I have not heard that being used very common, and I understand there may be a pretty significant downside to owning minerals in an S corp. From what I've read was that there is the implication that you are not able to take a step up in basis when you own it in an S corp. And so what that means basically is when someone passes away, normally if you inherit minerals, your cost basis in that asset is what the value was as of the date of death or an alternate valuation date. And the benefit for that, with the appreciation in value over time with property in general, but, with certainly since the shale revolution, minerals that maybe were worth a few $1,000s when your ancestor inherited them, maybe worth hundreds of thousands of dollars now when you inherit them from them. And if you decide to sell in the future, you only have to pay capital gains tax on the difference between the proceeds of the sale and your basis in that property. So, again, we'll just throw some numbers out there just to illustrate the example. If you had minerals and you inherited them and on the date of death, it was worth $100,000. You sell the minerals for $150,000 a few years later. Your capital gains tax liability is calculated based on that $50,000 gain between what you sold it for and what that basis was. And so that means that you can save significantly on capital gains taxes from that ability to claim that step up in basis. And if you have them in your S corp, apparently you're not allowed to claim a step up in basis to minimize future capital gains taxes. So that could be a huge issue if they're very valuable minerals. It means that your tax bill down the road, if you decided to sell them ever, would be significantly higher. So that alone, Maria, is in my mind a reason to kind of rethink that. And, certainly getting with your financial advisor, your CPA, potentially a good oil and gas attorney to understand the different options and to come up with the ownership structure that meets the goals, but then also allows you to take advantage of some of those different things with, the different ownership types. Now, as far as deductions and taxes and all that, so I own minerals in a couple different states, and I have to file income tax returns in those states where I have minerals. So, for example, Oklahoma. So even though I'm here in Colorado, I have some royalty interest in Oklahoma that I have to file an Oklahoma income tax return each year because of that. And so there's really no avoiding it. So even though you're quote unquote taxed on the same money in 5 different states, I'm not sure if you're referring to income tax and being taxed on those. Usually it's the state where you have residence. But I guess again, that's where this S Corp thing might get really complicated and muddy the waters there. And so again, getting with your CPA or attorney, because I really have no idea where to start on the S Corp tax liability, and if you have interest in multiple states and how that would work. But I think that if you generally own interest in multiple states, you do have to potentially pay income tax in those different states depending on the situation, or at least file a tax return. And then as far as deductions, you'd want to make sure that you're able to take the depletion deduction on the royalties you receive in the year. And a depletion deduction is basically allows you for like a percent depletion. There's cost depletion, there's percent depletion. Say 95% of royalty owners take the percent depletion, which allows you to deduct 15% of the royalty owner's taxable income from the property, up to 65% of your taxable income from other sources. So it's basically a similar concept to depreciation. So if you have another capital asset, like you had a rental property, you can depreciate that asset over time. Well, since oil and gas assets are depleting assets, it allows you to take a similar sort of tax deduction because of the depletion or the decrease in value that occurs over time. So again, get help from a qualified CPA. They can walk you through all that, make sure you're taking all of the deductions and all of those things that you're allowed based on what type of ownership structure you decide on eventually. So yeah, good luck.
And Matt, something worth mentioning is if you have several different properties, you should really find a good team. So that would be a CPA that is aware of minerals and has some experience with them. Also, mineral managers are an option, and that could be something worth looking into. Those are folks who manage minerals for a living and are familiar with all of these things. All right, Matt. So our next one here is from Stefan. Stefan says, what would you do if the division order is using an allocation method for the NRI calculation, but the permits and all filed documents with the state, it's a pooled unit? Using the acre calculation results in a severe increase of my NRI. So basically he's saying the allocation method and using the pooled method, that there's a difference in what his NRI would be. And, this is kind of another complicated one, Matt. But first and foremost, if you don't agree with what the division order says, don't sign it. That is the first thing. Don't sign and return that division order until you are satisfied with that calculation. And Matt, start with the operator. The operator might be able to quickly correct this. They might be able to explain why it is. And then next would be an oil and gas attorney. So that they could kind of look at this with you, look at your documents, your lease, to see if you do have a valid claim as far as using the different method and it being in your favor. What else, Matt?
Yeah, I think the other thing is that if the operator filed the permits based on forming a pooled unit, it stands to reason they should have to follow those requirements when paying the interest owners, because the Railroad Commission, in approving the permit, has reviewed the interest owners and how that was going to get paid out from a proration perspective and all of those things. And so the reason for switching it could be that they went down the route of trying to form a pooled unit and they couldn't get approval from all the minimum number of interest owners to pool it to form that unit. And they didn't go the MIPA route, which we talk about in another episode, which I'll link to in the show notes, where we talk about Texas Mineral Interest Pooling Act and allocation wells and all of those different things. But yeah, if they formed a pooled unit and that's more beneficial to you from a decimal interest in those wells, then I would, fight to have them honor that or at least find out why. And then, make sure that all the documents on the Railroad Commission are complete and up to date, because and again, that's where that attorney really comes in handy. And I think they can really advise you, because I think you need to get some help and advice specific to your situation. I don't think we have enough information to go by. And plus, I think we're not qualified to give you legal advice in that case anyway. But, I will say you have a good argument to be made. I think that you should be getting paid according to the pooling versus the allocation well. And again, if you're not familiar with those terms that we're talking about, in Texas, they have a unique way that they can quote unquote pool mineral interests together to allow them to drill a horizontal well. There's this concept of an allocation well, which it allows them to allocate production and royalty income across, your proportional share of that wellbore that goes through your property. So that basically allows them to pay fairly the people that are mineral interest owners, and then, despite maybe not having a pooling order in place through a MIPA, that Mineral Interest Pooling Act, or through an actual pooling agreement. And so that is something that is only really a Texas thing. And so that's, kind of where we understand that you're interested in Texas, because you're mentioning the allocation well situation. But, whatever you decide, the Texas Natural Resource Code, generally, if you have a claim, you need to make it in writing and by mail. So what I would do in that case is you could make that same demand via email, but then also follow up with like a certified mail letter, and your attorney can help you write that letter. But again, I think if there's a lot of money at stake, it's probably worth understanding the difference in value there, and hiring an attorney to get help, because there can be a significant difference in the decimal interest between the two different routes if you are pooled. So if the wellbore goes through your mineral tract, but it's a small portion of the overall length of that wellbore relative to the number of acres you own. Let's say the tract is very large and oblong, but only a narrow slit is where your well goes through. And so you're only going to get a very small portion of the royalties from that well relative to if they had pooled all of those mineral tracts together and you have a large percentage of the minerals, and you would have gotten a lot larger decimal in that well. And it can mean, between hundreds of thousands of dollars potentially if you have a big interest. So certainly worth sticking up for yourself and getting help from an attorney just to see what your options are, and to see if you can fight for that pooled unit if it's more advantageous to you.
A good team is really important when you have situations like this, especially if you do have a larger interest. Those people to rely on are really valuable when these different things come up as a mineral owner. All right, Matt. So our next one here says, what would be the procedure in Texas for reporting oil companies who don't pay? There's a very nice old man who's been cheated by a wealthy oil company since 2015, extracting oil and gas, but stopped paying him without explanation. He's the owner and signer of a lease in 1993 with all the records and tax receipts. I would like to see him paid before he dies. Can you provide information that would help him? And Matt, these are always kind of a tricky one, because just because he was being paid doesn't necessarily always mean that he should be paid now. Certainly something to look into, but we see a lot of people who get really angry before they truly understand what the issues might be. Good first steps to contact the operator, and then an oil and gas attorney. Doing a free consult with whatever documents you have would also be a great first step.
Yeah, that's great advice. And I think, like Justin said, there could be many reasons. We don't have enough information here to know, specifically what type of path to go down. But I think the first step would be to contact the operator and just find out why he's not getting paid. Is his interest in suspense? Maybe he moved and they tried to pay him and the check was returned. And so they have been accumulating funds and it's, either been escheated to the state, and he has to go claim, via the unclaimed property process, or it could be there's a title issue. Maybe they had some updated information that they found out that he actually wasn't the rightful owner of those interests. And so they, stopped paying him because of that title issue. So really, you need to contact the operator first to find out why they stopped paying him. Could be a valid reason. Again, if there is everything, according to the documents you have, still shows that he should be getting paid, and you're having issues contacting the operator, getting a response from the operator, then again, getting a quick consult from a Texas licensed attorney would be helpful. And they can advise you on the steps, to make those written demands, like we talked about in that previous question, because that is your recourse. The Railroad Commission or the Natural Resources Code has some very specific requirements for operators needing to pay mineral interest owners. And when certain things are in place. And one of the things that's unique to Texas is you have to have a signed division order, and the operator's off the hook from paying you unless you've signed and returned the division order. So maybe that well changed hands and they sent a division order, but they never got it back. So they have the interest in suspense. So again, there's many different reasons why he could be not getting paid, but you really will only find that out by contacting the operator and just, doing it in a polite, persistent way. I would say 90% of the operators out there are doing what they can to try to uphold the rules, and then also to protect themselves so they're not paying the wrong person. So sometimes that we're on the wrong side of that equation, and it means we stop getting paid or we get paid less because there's information that's come to light that shows we don't own what we thought we owned. But again, they can help advise why that's the case, and then you can use that information to figure out what your next steps are. So good luck.
Yeah, man, these are always kind of tricky. You kind of have to follow a trail of information, and connecting with the right people and helping them to, connect the dots for you is really how this goes. So stay persistent on trying to figure it out, and you certainly will. And don't be afraid to ask questions and look for experts in it. All right, our next one here was from YouTube, Matt. This is from Rob Williams. He says, I'm being offered $1,500 to sign and agree to pooling rights on an operating well I own. Is that a fair offer? Matt, and this is always a question too, whether it's a fair offer on a lease, or whether it's a fair offer on purchasing. This can be a thing that's at top of the mind for mineral owners and can be difficult to find out.
Yeah, and I think, Rob, the answer is it depends. We don't know if that's a $1,500 total payment or $1,500 an acre. And it also goes back to where the interests are located. If you're in Texas and, they're asking to pool, perhaps they're going to be drilling in a different formation, and that means that they want to try to form a pooled unit. Your minerals will be part of that unit. Then it may or may not be advantageous for you to sign and agree to the pooling. Really just depends on the specifics of your situation to know whether it's beneficial for you or it's going to be detrimental. And then from that, if really the way you would find out if agreeing to pooling, what the value is there. First of all, if it's going to give you a larger decimal and it's going to bring additional royalties, then, clearly the pooling route would be better. Again, depending on the specific language and all the things, and make sure you get an attorney to help review any document before you sign it, I guess is the other, piece of advice. But, that being said, if they're offering you $1,500 an acre or whether it's $1,500 total, it's up to you to decide, is that a fair offer? And, always try to negotiate. That's the first offer is not their final offer usually. And so you can try to see if they will be willing to pay you more. And the way I would look at it is similar to a lease bonus. So even if, so we don't know if you're an unleased co-tenant in that operating well where you own minerals, or if you have a lease already and they're basically amending the language of the lease to allow for pooling. Well, I would look at that like whatever the going rate is from a lease bonus perspective, that would be what I would try to get for basically amending that lease. And that could be another opportunity. So if they're asking to amend the lease, that in my mind opens up the opportunity to renegotiate the whole thing. And one of the things could be that if it's really beneficial for them to get these pooling rights and you have a very low royalty rate, you could try to see if this is an opportunity, maybe for a lower bonus payment to get a higher royalty for now and forever going forward on those producing wells. That could be a great opportunity. So I think really getting a qualified attorney licensed in the state where your minerals are located is the first step. And they can help advise and come up with some different language you could add potentially and help you negotiate that lease to try to get that pooling agreement to get the best outcome. And there's many different things based on what you provided. There's lots of different scenarios I can envision and different ways to tackle it. But that's where I would start.
Yeah, you said it, Matt. And it's it'll be a journey to kind of figure it out, but it may be a good opportunity, like Matt said, to be able to have this conversation and see what you can do there. Our next one, Matt, is from Susan. Susan says, we're in Texas. What can I do when the main person at an oil company refuses to send a division order to sign, yet has sent an email confirming that they owe us money? What state agencies handle this? Matt, this is kind of a common thing we hear as well. There could be several reasons that this is happening. Susan, if there's a title defect, the operator would typically tell you that. So I would think that you'd kind of be aware of that already. But it could also be that they're just not ready to release division orders. Division order analyst has somebody that they're working with, and it's typically going to be a title attorney that is going to confirm and verify everything. And once that's done, then the division orders would go out. So Matt, we'll include a link to the show notes to episode 15, where we kind of talked about the timeline of they're going to drill on my land and how long before you start getting paid, which talks about each of the steps and what they're doing. So Susan, qualified oil and gas attorney would be the place to go if you need more help, or it's not just a case of waiting on regular business. But Matt, what else should Susan consider?
Yeah, and it depends on the situation. Like Justin said, if it's a new well, there's certain timing that's required, and they have to start paying you. And again, that Texas Natural Resources Code outlines that, and there are ways you can make demands for payment and interest that's due if they're late and they don't pay you in time when you've received a division order. And the other thing, if you have tried to obtain a division order and they're using that as the reason why they're not paying you, well, you didn't send the division order in, and so we're just told, we don't owe you royalties because, per the Natural Resources Code, you have to have a signed division order in order for us to owe you royalties and for that clock to start ticking. That would be, again, like Justin said, get help from an attorney. They can help you navigate that, because that could be a tactic they're using to kind of hold and play slow pay that in order to take advantage of holding that money and getting interest and using it for operations and all those things, rather than paying you in a timely manner. So, if that's the situation, then certainly getting an attorney and making the demand for payment. But really, ultimately, it's the Texas Railroad Commission that oversees and regulates the oil and gas activity in the state of Texas. So that's the organization or state agency where you can go to find more information. And then again, it's the Texas Natural Resources Code, which we'll link to in the show notes as well, in the section that talks about the payment statutes and all of that. But, I guess the silver lining to all this is you do have an interest, it sounds like, in that well or wells, if they're confirming that you are an owner. But like Justin said, if it's a new well and they've just recently drilled it and started producing, they actually have a few months before they have to pay you that first check after, sending division orders out, of course. And so it could be just like Justin said, that they're not quite there yet. They need to have some final adjustments and review from a title attorney on their division order title opinion, which those can get very complicated and long. And so there's a lot of things that they need to do, and they need to load all that information into their accounting system so that they can cut the royalty checks to the right people for the right amounts. And so that takes a little bit of time. So again, polite persistence pays here, and you just keeping in touch with that division order analyst or the person you're speaking with at the operating company can help you navigate that and make sure you stay top of mind and be the squeaky wheel that gets the grease, and be polite about it. But then it'll happen sooner than later, hopefully, and you can get paid.
You said it, man. All right, our next one here is from Bob. Bob says, I'm a mineral owner with a few hundred producing acres in the Marcellus Shale in Pennsylvania. I'm questioning whether my royalty payments are correct. The product on my royalty payments appear to be approximately 80% of what is being reported to the state, and the sales price always appears to be lower than Henry Hub prices. So I'm trying to confirm that I'm not being shorted. And Matt, it's great that you're looking at this, Bob, and checking on this, because this is something that I think mineral owners often don't do. They just kind of take for granted. But Matt, I know there's times the lease allows them to use some of the product on the well pad. I know there's some price differences from the wellhead. You want to dive into that for Bob?
Yeah, and it depends on the makeup of the gas, and is it all dry gas? In other words, is it just the the methane and things like that? So it's very similar to like actual natural gas. Or does it have a lot of natural gas liquids, in which case you'll have some amount of shrink that occurs. And what that means is the gross amount of gas that's produced at the wellhead is going to be more than when they process it at the gas plant and extract out those natural gas liquids, because that has some volume to it. The remaining gas that is sold as natural gas will be lower than that total volume that's produced at the wellhead. And then the difference there should be the natural gas liquids. And so if that's the case, a lot of natural gas liquids, it's pretty dry gas generally. But if you're kind of on the edge, because I know there's sort of a band, right? It goes from gas to, having some of those natural gas liquids to then oil. So it depends on where you are in that spectrum and what your makeup of the product that's being produced at the wellhead. So that would be my first thing, is looking at your statement and seeing what products are being reported there. And if you have natural gas plus natural gas liquids, that would be the first thing that would lead me to believe that's the explanation for the difference. In that case, so ultimately, from a volume standpoint, the total of those two multiplied by the price of the natural gas liquids times the natural gas liquids volume, and then the remaining natural gas times the gas price, those should in total be more than or at least equal to the raw gas number that's on the reported to the state multiplied by the gas price, because there's a lot of value in those natural gas liquids. So it's a good thing that they're extracting them out, even if it means there's less natural gas that's a result after the processing in the gas plant. So that would be the first thing. And then the other thing, from a natural gas price perspective, one of the issues you get with local markets is it's not uncommon for the actual price to be paid at the wellhead to be lower than the benchmark price. In this case, Henry Hub, which he's referring to, is the benchmark price for natural gas, which is traded on the NYMEX commodities exchange. And Henry Hub refers to a specific location in Louisiana, and basically that Gulf Coast area where the natural gas is there. And there's lots of infrastructure. There's lots of takeaway capacity. There's lots of LNG terminals and all of that. In the Northeast and Appalachia, because of political reasons, there is a limit on the amount of pipeline capacity and takeaway capacity there. So there's a lot of times where there's been a lot of drilling because gas prices are good. So there's a little bit of a local glut in gas. And that's the reason why your prices are lower than Henry Hub, because they don't have a way to, for example, send it via pipeline to New York, where there's a lot of demand for natural gas. Because of political reasons, they didn't want to build a pipeline there across the state. And so, they have extra gas there, and, they're trying to figure out what to do with it. And so that's why the prices are lower. It's just a supply and demand thing. But we'll link in the show notes, Bob. There's a couple episodes I would recommend going and listening to. The first one is about royalty audits and litigation with Spencer Cox, attorney. And then we have episode 97, where we talk about how to audit your oil and gas royalty statements. And there's some different things that we talk about in those episodes that I think will help you do a little quick and easy confirmation on what you're getting paid versus what you think you should be getting paid, to make sure it's in the ballpark. And if it's, if there is an issue, maybe that you need to get a royalty audit, it might be worth paying to have that done, particularly if you have a few hundred net acres. It could be thousands of dollars on the line. So again, I think getting with an attorney that's licensed in Pennsylvania to help you navigate that. They may have some ideas of local accounting firms or mineral managers that can help you do a royalty audit. And it depends on the terms of your lease as well as to what you're entitled to do. But that might be a good path to go down, given the amount of interest and the number of acres you have.
You said it, Matt. And, with this, we often talk about that it's really a return on investment thing. If you could get to a point to where you might have a number that seems somewhat realistic to you, and then you'd have an idea of talking with attorneys and what a royalty audit would cost, if that's something that would be advantageous for you, which, like you said, Matt, with a large interest, maybe it would be.
Absolutely.
All right. So our next one here is from Wesley. Wesley says, hey, Matt, like your podcast, very informative. I have a question about ratifying a state pooling agreement. As the mineral owner, the operator originally wanted me to sign a ratification of state pooling agreement to pool the Wolfcamp formation. I think I was okay with that, but now they want to revise the ratification and include all of the Bone Springs as well. What are your thoughts on that? Any help is much appreciated. Matt, so this is an interesting question. I've never heard it asked in quite this way. So I thought it was pretty interesting what they're looking for. And they mentioned the Wolfcamp and Bone Springs, which are both popular formations. But can you explain from even the operator's perspective, what are they trying to do here?
Yeah, so it's because those are different formations at different depths, and it depends on the state, and probably in Texas, from what you're talking about, it could be New Mexico. But in any case, there are certain requirements, and as they review drilling permits and the formations that are being produced from, they have certain rules in place to prevent waste and to protect the correlative rights. And so what that means is basically, if you have interest in one area, they can't drill a well and suck all the oil out and screw everybody else that's, surrounding mineral owners that aren't part of that unit. And so the rules are in place to allow them to pool different mineral tracts together in different formations so that they can develop and drill. And then in many cases, in parts of New Mexico and Texas, are drilling through multiple formations from the same well pad. So when you see the permits filed with the state, those may be going through different formations. Some of them may be going through the Bone Spring. Some of them may be going through the Wolfcamp. And so what it means is likely that they're planning perhaps some additional wells in the Bone Spring, in which case, they need approval to drill those additional wells in the pool. And so I think, again, if you are in Texas, it would be the same advice I would give relative to the question that was asked, earlier in this episode where we talked about the decimal and they first pooled and then they did allocation well and it's now detrimental. What do they do? Well, same sort of analysis you would want to do is to see if it's advantageous to you to go the pooling route or to go the allocation well route if it's in Texas. Again, that's a very specific thing for Texas. And again, to talk about, and I think for all the listeners that are in this situation, highly recommend you become a member of NARO, because with the National Association of Royalty Owners, we have webinars, and we have one that we recorded on allocation wells. And so it's Allocation Nation, how Texas operators navigate the no-force pooling landscape. If you're a NARO member, you can go into the members section and see all the webinar recordings and watch that webinar. Jimmy Wright and I hosted that webinar, and we talked about how specifically in Texas you would calculate your decimal interest between a pooling situation and an allocation well situation under a couple of different hypothetical examples just to illustrate the concept. And so highly valuable information. And, you can become a member for only $50. If you're a new member, you can use code MRPodcast to save $25 off of an introductory membership, which is normally $75. Brings it down to $50. I think it's a tremendous value just in the information you'll get from that. Just in watching those recorded webinars, we have live webinars every month and in-person events and newsletters and all of that. So a great value for only $50. If you're not a member, do it today. It's something that's, in my mind, every mineral and royalty owner should be a member of NARO. For that price, it opens it up to almost everybody that receives royalties.
You said it, Matt, and it's a wonderful way to stay up to date. And also, we talk a lot about putting your team together. This is the place you meet your team. These are a lot of industry-related folks, and the National Association of Royalty Owners attracts the folks who want to serve those mineral owners. Yeah,
and to Justin's point, if all the advice we've given in this episode and in many episodes, say, hey, contact a good attorney in that state or contact a CPA. And if you don't have somebody, I know it can be a daunting task to try to find somebody that is good. And we have companies and partners that have sponsored at events and been exhibitors at events, and that have reached a certain threshold in their support. We have them listed in a supporter directory. So as a NARO member, you get access to that supporter directory. We can find qualified mineral managers, a person doing appraisal. You can get help from landmen, all the things. So definitely check it out. It's that alone, saving the time and effort of trying to find out who to call to get help on a situation like this. We sort of pre-vetted those folks, that have done good work for other mineral and royalty owners and that are sponsoring and supporting NARO. So highly recommend that. And that would be, I guess, my take, Wesley, is pooling is a good thing because it allows them to develop those interests, to pay you royalties. There's a lot of nuance to it, though, and depending on your situation, it may be advantageous to not sign the pooling agreement versus and go the allocation well route. Again, if you're in Texas, if you're in other states, pooling is the only mechanism where they're going to drill that well. So whether you agree to a lease that has pooling provisions or you're force pooled and you get whatever the terms are offered at that point, pooling is the route that is used to combine together multiple mineral tracts so they can drill horizontal wells through it. So in principle, pooling is a good thing because it allows them to drill the wells and then to pay you royalties. So just want to get that out there that that is a process that is used in every other state besides Texas, and it's a good thing from that standpoint.
You said it, Matt. Well, that wraps it up for listener questions this go round.
Yep, lots of good questions. Thanks again for submitting them. If you have a question you'd like us to answer, send it to feedback@mineralrightspodcast.com. And thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.